They tell you not to put all your eggs in one basket. It is the first rule of finance. It is the golden commandment written on the stone tablets of every financial advisor, every robo-advisor, and every broke brother-in-law at Thanksgiving dinner. Diversify. Spread your risk. Buy the whole market. Own a little bit of everything so that if one thing fails, you don't die. In the Stone Age, this was bad advice. If you were a hunter and you tried to hunt a mammoth, a saber-toothed tiger, a deer, and a rabbit all at the same time, you didn't end up with a diverse dinner. Or worse, you ended up being the dinner. Survival required singular, absolute focus. It required putting all your energy, all your skill, and all your spears into one target until that target was down. But in the modern financial world, we have been brainwashed into believing that focus is dangerous. We have been sold a narrative that average is the goal. We have been told that the path to wealth is to own 500 different companies that we know nothing about, managed by people we have never met, in hopes that 7% compounding will save us 40 years from now. I am here to tell you that for the middle class, diversification is not a shield. It is a cage. It is a mathematical trick designed to keep you in the middle. It is a strategy for wealth preservation, sold to people who have no wealth to preserve. My name is Brock, and today we are going to slaughter the sacred cow of diversification. We are going to look at the math of why spreading your bets guarantees you will lose the game. We are going to examine how the richest people in history actually built their fortunes, and I am going to show you why concentration, the terrifying act of going all in, is the only bridge across the chasm of the middle class. Let's start by defining what diversification actually does. Modern portfolio theory, which won a Nobel Prize, essentially says that by combining assets that don't move together, you can reduce volatility. You can smooth out the ride. If stocks go down, bonds might go up. If the US market crashes, maybe the emerging markets will pop. It is designed to minimize variance. But here is the ugly truth that your financial advisor won't tell you. Variance is the only way you get rich. Volatility is the price of admission for returns. By eliminating the downside volatility, you are mathematically decapitating your upside volatility. You are flattening the curve of your life. If you have $10,000 to invest, and you listen to the standard advice, you might buy an S&P 500 index fund. You now own a tiny sliver of 500 companies. Apple, Microsoft, Amazon, but also hundreds of dying retail chains, stagnant banks, and utility companies that haven't grown in a decade. Let's say one of those companies invents cold fusion tomorrow. Let's say their stock goes up 1,000% in a single day. A miracle. A black swan event. How does that affect your life? It doesn't, because that company makes up maybe 0.05% of your portfolio. A 1,000% gain on 0.05% of your portfolio is a rounding error. You might be able to buy a free appetizer at Applebee's with your winnings. Diversification dilutes the winners until they are invisible. It takes the rocket fuel of a high-performance asset and mixes it with 499 buckets of water. This strategy works perfectly if you already have $100 million. If you have $100 million, you don't need to get rich. You are already rich. You need to stay rich. You need to make sure that no single disaster can wipe you out. For the ultra-wealthy, diversification is insurance. But if you are in the middle class, if you have $10,000 or $50,000 or even $100,000, you are not in a position to defend. You are in a position where you need to attack. You have a mountain to climb, and you cannot climb a mountain by walking sideways. Diversification for a person with no capital is like wearing a suit of armor to run a marathon. It feels safe, but it ensures you will never finish the race. Let's look at history. Let's look at the titans of industry, the people who actually escaped the gravity of the middle class. Did they diversify? Andrew Carnegie, the steel magnate, famously said, "Put all your eggs in one basket, and then watch that basket." John D. Rockefeller didn't buy a basket of energy stocks. He bought Standard Oil. He focused entirely on one industry, one company, one vision. Bill Gates didn't diversify his portfolio in the 1980s. He didn't hedge his bets by buying stock in Ford or General Electric. He was 100% in Microsoft. He was all in. If Microsoft had failed, Bill Gates would have gone to zero. But because he was concentrated, when Microsoft won, he became the richest man on earth. Elon Musk. When he sold PayPal, he had $180 million. A financial advisor would have told him, "Put this in a diversified trust, live off the interest, and you will be safe forever." Musk took that $180 million and put $100 million into SpaceX, $70 million into Tesla, and $10 million into SolarCity. He literally had to borrow money for rent. He concentrated his capital to the point of insanity. And that concentration is why he is worth hundreds of billions today. Now, I know what you are thinking. But Brock, those are the survivors. What about the guys who went all in and lost? That is a valid fear. That is the tiger in the bushes. But we have to look at the math of the middle class. If you stay diversified, you are guaranteed to stay in the middle class. The safe path has a 100% failure rate for creating generational wealth. It has a 100% success rate for creating mediocrity. If you concentrate, yes, you might lose. You might go to zero. But you are young. You can recover from zero. You cannot recover from a lifetime of average. The risk of concentration is temporary failure. The risk of diversification is permanent stagnation. Warren Buffett, the god of investing, is often misquoted by the diversification cult. They love to talk about his portfolio now. But Buffett himself said, "Diversification is protection against ignorance." It makes little sense if you know what you are doing. Read that again. Protection against ignorance. When you buy an index fund, you are admitting, "I don't know which companies will win, so I will buy all of them." You are admitting ignorance, and there is nothing wrong with that if you are passive. But you cannot expect a premium return on ignorance. The market pays for insight. The market pays for conviction. The market pays for doing the homework that other people are too lazy to do. This brings us to the concept of diversification. This was a term coined by legendary investor Peter Lynch. It describes what happens when you add more assets to your portfolio just for the sake of adding them. And you actually lower your expected return and increase your risk. Most people think that adding more stocks lowers risk, but if you have 5 great ideas and you force yourself to buy a 6th, 7th, and 8th stock just to diversify, you are taking money away from your best ideas and putting it into your mediocre ideas. You are selling your winners to buy losers. You are watering down your conviction. If you do the research and you find a company, or a real estate deal, or a crypto asset that you truly believe in, one where you have done the deep dive, you understand the mechanics, and you see the asymmetry, why would you put 2% of your money into it? If it's a great idea, it deserves 20%. It deserves 50%. The middle class has been taught to fear company-specific risk. They are terrified that Enron will happen to them, but they completely ignore systemic risk. When you own the whole market, you own the systemic risk of the whole economy. In 2008, diversification did not save you. Everything went down. Stocks went down. Real estate went down. Commodities went down. The correlation of all assets went to 1. The only thing that saved people in 2008 was having cash or having a specific, concentrated bet against the market. So, if diversification is a lie for the accumulation phase, what is the alternative? How do we actually build wealth without recklessly gambling? The answer is the barbell strategy. The barbell strategy is a concept formalized by Nassim Taleb. Imagine a barbell. On one side, you have extreme safety. On the other side, you have extreme risk. Most people live in the middle. They have medium risk and medium reward. They have corporate jobs that seem safe but can lay them off at any moment. They have portfolios that yield 7% but can drop 20%. They are exposed to the slow bleed. The barbell strategy rejects the middle. On the left side of the barbell, you have your safety net. This is cash. This is a paid-off house. This is gold. This is the capital that ensures you will never, ever be homeless. You don't take risks with this money. You don't chase yield here. This is your don't die fund. On the right side of the barbell, you take massive, concentrated, asymmetric risks. You put money into a startup. You buy a volatile crypto asset. You start a business. You invest in a single high-conviction stock. You ignore the middle. You don't buy bonds. You don't buy balanced mutual funds. You are either sleeping in a fortress or you are storming the castle. There is no in-between. This strategy works because the safe side keeps you in the game, while the risky side exposes you to positive black swans, those rare events that return 100x or 1000x. If you have 90% of your money in cash and 10% in Bitcoin, back in 2013, but if Bitcoin went to the moon, which it did, your total net worth doubled, tripled, quadrupled. That is the power of asymmetry. That is the power of concentration. But the most important asset you need to concentrate on isn't a stock. It isn't a crypto token. It is you. The ultimate diversification myth is the idea that you should have a well-rounded career. We are told to be generalists. We are told to have a broad set of skills. In the Stone Age, being a generalist was good. You needed to know how to start a fire, how to skin a rabbit, how to find water, and how to fight. If you only knew how to skin a rabbit, you died of thirst. But in the modern economic machine, the generalist is the commodity. The generalist is easily replaced. The generalist gets paid the average wage. The immense rewards in our society go to the specialist. The person who is the top 1% in the world at one specific, difficult thing. The neurosurgeon gets paid 50 times more than the general practitioner. The specialized AI engineer gets paid 20 times more than the general IT support guy. Concentrating your human capital is the highest ROI investment you can make. Instead of trying to be pretty good at marketing and coding and accounting and sales, pick one. And go deep. Go so deep that you become undeniable. When you concentrate your effort into a single skill set, you achieve escape velocity. You move past the point of competition. You become a monopoly of one, and once you have that high-income skill, you can generate the cash flow to take those concentrated financial bets. There is a psychological cost to this, of course. Concentration is lonely. When you are diversified, you are part of the herd. If the market crashes, everyone loses money together. You can go to the water cooler and complain about the economy with your co-workers. There is a shared comfort in collective failure. We all lost money, you say. It feels okay because you are not the idiot. You are just a victim of the times. When you are concentrated, you are alone. If you bet on a single company and it fails, you don't get sympathy. You get, "I told you so." You look like a fool. You have to carry the weight of that decision by yourself. But if you win, you also win alone. You separate from the pack. And that separation is terrifying to the Stone Age brain. Your amygdala screams that separation means death. It screams that if you leave the tribe, the tiger will get you. You have to override that software. You have to understand that in the 21st century, the herd is walking off a cliff. The herd is headed for a retirement of mediocrity, inflation-eroded savings, and golden years spent watching cable news in a nursing home. Leaving the herd is the safest thing you can do. Let's talk about the knowledge gap. The reason Wall Street pushes diversification is because it is a product they can scale. It requires zero knowledge from the customer. They can sell the same S&P 500 fund to a doctor, a plumber, and a teacher. It is a one-size-fits-all solution for people who don't want to think. Concentration requires work. It requires you to actually read the annual report. It requires you to understand the tokenomics. It requires you to study the local real estate zoning laws. Most people are lazy. They want the return without the effort. They want the passive income, so they accept the passive mediocrity of diversification. If you want to escape the middle class, you have to become an active participant in your own rescue. You have to treat your capital like a soldier, not a tourist. A tourist wanders around looking at everything a little bit. A soldier focuses on the objective and captures the hill. So, how do you execute this? How do you transition from a spray and pray diversified portfolio to a sniper concentrated portfolio? You start by pruning. You look at your portfolio and you ask a brutal question for every single line item. If I didn't own this today, would I buy it right now? If the answer is no, sell it. Get rid of the junk. Get rid of the mutual funds with high fees that just hug the index. Get rid of the random stocks you bought because your cousin mentioned them. Consolidate your capital. Then you wait. You sit on cash. You sit on the safe side of the barbell. And you study. You learn. You look for the fat pitch. Warren Buffett uses the punch card analogy. He says you should invest as if you have a punch card with only 20 slots for your entire lifetime. Every time you make an investment, you punch a hole. Once you hit 20, you are done. You can never buy another asset. If you lived by that rule, would you buy that random ETF? Would you buy that speculative penny stock? No. You would wait. You would be patient. And when you finally saw something that was a screaming buy, something you understood inside and out, something with asymmetric upside, you wouldn't put 2% of your money in it. You would back the truck up. You would swing hard. This is how wealth is made. It is made by waiting and then striking with overwhelming force. The loyalty we talked about in previous discussions applies here too. Don't be loyal to a strategy just because everyone else is doing it. Don't be loyal to conventional wisdom. Conventional wisdom gets you conventional results. The middle class is a trap designed by the system. It keeps you working, keeps you consuming, and keeps you investing in broad indices to prop up the market for the elites. Diversification is the fence around that trap. It keeps you feeling safe while ensuring you never accumulate enough power to break free. You have to break the fence. You have to be willing to look stupid for a while. You have to be willing to see your portfolio swing wildly. You have to be willing to endure the volatility that washes out the weak hands. Think about the farmer. A farmer does not diversify. He plants corn. He bets his entire year, his entire livelihood, on that corn. He works the soil, he watches the weather, he protects the crop. He is concentrated. If the corn fails, he hurts. But if the corn yields, he feeds the world. Be the farmer. Don't be the tourist gathering wildflowers. Plant your seeds deep. Watch them. Protect them. This isn't reckless gambling. Gambling is betting on things you don't control and don't understand. Concentration is betting on things you do understand and have high conviction in. The lie of diversification is comfortable. It feels like a warm blanket, but that blanket is slowly suffocating your financial potential. It is the someday lie wrapped in math equations. Take off the blanket. Step out into the cold. Pick your target. Sharpen your spear and throw it with everything you have. You might miss. You might have to hunt again. But the one time you hit, I'm Brock. Stop hiding in the herd. Focus your fire. I'll see you in the next one.